Hi, very good morning, ladies and gentlemen. So, a warm welcome to What and Where to Invest 2021. So, I'm Colin, the Senior Analyst for Macro Research Team, and today I'll be bringing you guys through the IFAST Outlook 2021, and more importantly, what and where to invest in this year. So, let's kick things off with laying out the backdrop for the macro outlook this year. So, first, I think for investors, it's critical to know what phase of the economic cycle we are in right now because it has implications on your corporate profitability, your economic growth, as well as to help us with the asset allocation decision. So in simple terms, it is telling us where we will be and help us understand how to get there. So I think the good news is here that we already passed the trough and we are at the early phase of the economic expansion and we will be entering a global cyclical recovery. So over the next couple of slides, I'll explain why some indicators are pointing to that. And these indicators are very sensitive to the economic activities and therefore are good leading indicators. So firstly, global PMIs. So as seen from the table right here, you can see that from the July and August period onwards, PMI has rebounded significantly in a sustained fashion as well as a synchronized fashion over the DMs as well as the EMs. So this is a good sign to tell us that, hey, we're out of the trough and we are recovering indeed. And I think if you look across the board, the broad-based recovery itself also lends credence to our belief that it is a global broad-based cyclical recovery. So if you can take a look here at the world, the global trade as well as global export numbers. So these are indicators that are very, very cyclical and very sensitive to economic activities. So on the chart on the left-hand side, you can see that World Trade Volume Index, as well as the year-on-year change itself, has rebounded back to pre-COVID levels. And on the chart on the right-hand side, if you look at the top 5 global exporters, you'll find a recovery in exports in almost a very synchronized and sustained fashion over the past couple of months. So all in all, the trade and export data are implying that we're out of the trough right now and the cyclical recovery is kicking in. And last but certainly not least, if you look at the metal markets, so metal markets are also very cyclical and the prices themselves actually reflects the market's expectation of recovery because of its economic usage. And if you look at the chart on the left-hand side and look at the raw industrial metal index, you'll find a robust rebound since a March low, and this mirrors what we have seen coming out of the recession over the past few cycles. So you have to dig a little deeper into that and look at the particular prices of metals such as your copper, your iron ore, you'll find that hey, prices actually rebounded quite a lot last year. And this particular rebound price is important because that reflects market's expectation of a positive global recovery. So now that we have laid the groundwork for the potential case for a cyclical recovery, our outlook for this year remains very constructive, and we believe the biggest theme this year will be a vaccine-led cyclical recovery. And if you look at the GDP growth across all the nations and all the different sectors, different regions, we'll find that we expect above consensus global GDP growth of 5.8% this year, and particularly across the different regions, you'll find Asia, particularly China, should lead global growth this year. So now that we have laid a foundation for the macro outlook, so let us jump into the equity outlook this year. So I'm sure many of you know that valuations have in fact surged over the past 3 quarters and now elevated to heady levels. So we believe that numbers right now actually priced in a recovery for this year as well as the next year. So if we can take a closer look at the chart here, you'll see that, hey, the multiples themselves are trading above the historical means for most of the markets. And in fact, while some of the markets are trading at the top range of a 10-year historical average. So with that said, while valuations remain high, our outlook remains positive this year. And our optimistic stance is supported by 4 key reasons. So number one, we do expect a positive, robust EPS recovery this year, and that itself will be driven by the cyclical sectors. And number 2, we see supportive macro and as well as a policy backdrop. So with the likes of low interest rate and heavy central bank support to resume and to maintain this year. And thirdly, based on our projection, we expect stronger returns for equity markets over fixed income. And lastly, if you look at the risk side of stuff, we are expecting a milder risk backdrop this year, and that itself should be positive for risk assets such as equity markets. So all in all, this points to our preference for a pro-risk as well as a pro-cyclical exposure this year, and we recommend investors to hold a modest overweight of equities over fixed income. So with that said, having established our preference for pro-risk as well as a pro-cyclical exposure, we believe to best express this are 2 regional equities, which are emerging markets as well as Asia ex Japan. I think aside from that, the embeds the cyclicality tilt that we so favors, and also beyond that, on a regional basis, the outlook for EM as well as Asia ex Japan equities remain very favorable, and we are expecting strong returns this year. So broadly speaking, I believe that 2021 will be the year for EMs, and there are several factors that I will go through over the next couple of slides to highlight so. So firstly, we are expecting a robust growth rebound that is in the works for emerging markets. So if you can take a look at this chart right here, historically, coming out of the recession, growth has been very strong, and in fact, growth itself has been stronger than historical average of 5.5%. And because of a cyclical tilt, as well as a possible uplift in the commodity cycle, we are expecting a stronger than consensus forecast of a growth rate for emerging markets this year as well as the next year. So the second reason is that for EM equities, we believe that they are ready for a strong cyclical rebound EPS recovery. So similar to the slide that I just presented, coming out of the recession or coming out of the tail end of the cycle, we can see that there is very, very strong cyclical EPS recovery for emerging markets. So the range typically comes out to about 30 to 60% across the past few cycles. And the key reason is because EM has a huge cyclical exposure at about 60 to 70% of the entire index. And therefore, if you look at our projection this year, from a bottom-up basis, we are expecting a growth rate of a high double-digit growth rate of about 37% as well as 27% for this year and the next. So another thing you might notice here is that our projections remains higher than consensus estimates. And the key reason underpins that is because when we look at EM equities from a sectoral level, we'll find that, hey, consensus are in fact actually more conservative on the estimates. And because of that, we see an impetus for positive price reaction that is coming from earnings upgrade this year and next year for emerging market equities. And moving on to my third reason, shown quite clearly on this slide, is that the US dollar actually moves in waves, and right now, because of the recent weakness, it's a clear sign that it is in the initial phase of a multi-year down cycle. So this has huge implication for the emerging market equities, because if we can take a close look at this chart, you'll find very strong negative correlation between the dollar strength as well as EM performance. So meaning to say that whenever the dollar weakens, EM performance strengthens. So if we were to expect a multi-year down cycle for the US dollar, similarly, we can expect a multi-year support for emerging markets equities. So in this case, I might be wrong, and I've been wrong quite a couple of times. But if you look at this tight correlation here, I think that lends credence to my belief that we will see multi-year support for EM equities moving ahead. So moving on to my fourth and final reason, we believe the commodity upcycle is about to kick in this year, and we see two reasons that supports this. So firstly, we see a demand and supply mismatch in many of the commodity complex. And the second reason is a weaker dollar. So like I mentioned earlier, a weaker dollar itself is good for EM equities. So it also helps with commodity prices. So the chart on the left also shows quite strong negative correlation between the dollar strength as well as the commodity prices. And then whenever the dollar weakens, commodity prices appreciates. So this has a really good, really significant implication for EM equities, particularly on a fundamental reason. So as seen from the chart on the right-hand side, you can quite clearly tell that rising commodity prices actually help boost EM corporate profitability. So with more in detail regarding that, you can see that whenever commodity prices rises, it leads corporate earnings for EM equities by about 3 months. So that is a very clear indicator that we are expecting earnings to recover for EM equity markets. So to put things in perspective, what we really see in emerging markets equities right now is that there is a huge cocktail of tailwinds that is supporting emerging markets. So this particular combination of a dollar, commodity cycle, as well as cyclical growth and EPS recovery itself, the last time we saw that was more than 10 years ago, right after the GFC. So what we are expecting right now is the combination to carry emerging market equities forward this year. And with that said, we are expecting an attractive upside potential of 70% by end 2022. So for Asia ex-Japan equities, we believe it has the best risk-reward offered amongst EMs. So as a side note, much of the Asia ex-Japan equities itself falls under the EM universe and therefore are uplifted by similar tailwinds that the EM experiences. So for example, the weaker dollar as well as the cyclical economic growth and cyclical EPS recovery. And aside from that, we view Asian ex-Japan equities as the least risky segments amongst EMs and therefore having the best risk-reward offered. And with that said, we are expecting a strong return of about 18% by end 2022. So here is something interesting about Asia ex-Japan equities. So as can be seen from this chart, which is the FSMI Asia ex-Japan equity performance chart. And this chart in fact, is the aggregate of the performance for all Asia and Japan equity funds on our platform. So a quick look at this chart, you can tell that the trend is clear. Active management in the form of UT provides good long-term returns, and what we believe that is that investors should capitalize on this to gain the excess return that is offered to them by active management. So after covering the equity markets on a regional basis, here are our top single market equity picks for the year. So in summary, we favor China, Hong Kong, South Korea, Indonesia, and Brazil, and we see an upside potential between 18 to 24%. So you might notice that Brazil there stands out as it's not the Asian EMs out there. So that reflects our view that as the global recovery kicks in, investors should diversify into the EMX Asia region, and doing so, they will see attractive opportunities from regions such as, or single markets such as Brazil or even Russia. So having covered the equity outlook, so let us move on into the fixed income outlook. So I think it is important for you hunters, for fixed income investors alike, to first understand what is the yield and rates condition or environment around the world. So as shown in this chart right here, the major government bond yields have sunk to tremendously low levels over the past 4 decades, and particularly so over the past 3 to 5 years. So while we think rates itself are unlikely to sink much further, it is also unlikely to rise over the next 1 to 2 years. And with that said, as shown in this chart right now, the yields across the different fixed income segments remains at very paltry levels. So a quick look at that, you can find that yields itself remain below historical means for almost across all the different major segments. And certainly it is a mile away from levels seen in March last year. So the same can be said if you then take a closer look at this slide in terms of spreads across major fixed income segments. So spreads itself have compressed quite tremendously over the past 1 or 2 quarters. And for most segments itself, they are below historical average. So similar to what we observe in equity markets, valuation and fixed income have become quite full. But with that said, we believe value still can be found in select high yield segments. So this year, our recommendation for the fixed income segment is to favor high yield over investment grade. So broadly speaking, we see 3 fundamental dynamics supporting high yield. So number 1, it is aggressive search for yield. Number 2 is the rising risk appetite. And lastly, improving economic and credit fundamentals for both corporates as well as sovereigns. So with that said, Asia high yield remains our top pick within the bunch. And over the next couple of slides, I'll show some reasons why. So the first key reason is the beefy yield pickup engendered by the Asian high yield region. So what you see from this chart is that the Asian high yield segment itself offers a yield pickup of about 470 to 650 basis points over the investment grade peers. And it also offers a yield pickup of 90 to 350 basis points over its high yield counterparts. So this is important because in the current low yield environment, having such a high yield pickup itself is significant for investors, and this means it's a good time to enter into Asian high yield as well. But above and beyond that, if you compare to a historical basis, where you compare the blue chart, the blue bar chart and the green bar chart, you'll find that, hey, as an investor right now, I'm having a yield pickup that allows me to have higher than what I should be having across the historical average level. And moving to the second factor, if you look at spreads for Asian high yield itself, we believe that spreads itself are still very attractive because it is one of the few segments that is still above historical mean. And if you look at the possibility of spreads compressing to pre-COVID level, which we believe is a reasonable expectation based on the macro perspective, based on our macro outlook, we see ample room for compression. So there is about 200 basis point room for compression. And what that translates to is a very attractive potential upside once you account for the spread duration. So moving to my last point, if you look at the spreads, you do have to look at default risk in conjunction as well. So what we expect for default rates for Asian high yield segment is that we are projecting a default rate of about 2.5% by end 2021. So if you look at spreads level now, so what spreads are implying is a default rate of 4.1%. That is using a historical recovery rate of 40%. So in short, spreads compensates for almost double the forecasted default rate. And if you look across the spectrum for what is the forecasted default rate across a consensus, you'll find the most pessimistic estimates will be about 4%. So this also means that spreads right now adequately compensates for the worst case scenario that is forecasted by consensus. And with that said, I think that sums up why we favor Asia High Yield. But nonetheless, there are there are other segments that we favor, namely EM hard currency and EM local currency. So a key reason why we favor EM hard currency is because of its room for spread compression. So as shown from the table here, you can find that, hey, EM hard currencies right now is offering a spread of around 350 basis points. So there is quite plenty of room to compress to, say, a pre-COVID level of 260 basis points. And if you take account of its high duration and the spread duration itself, we believe the compression gains that is being translated to the total return of EM hard currency can be relatively attractive. And for the last reason, for the last segments that we favor, which is EM local currency, we also do see some room for compression, but at the same time, total return itself will be held by currency appreciation for the EMs. So right now, if you look across the board, EM currencies are some of the most undervalued currency against the dollar. So particularly, say, Brazilian real itself. So we believe based on the real valuation methodology, Brazilian real itself somewhere around 20% undervalued as compared to the US dollar. So if you do add in currency appreciation to spread compression gains, then we'll find that, hey, EM local currency actually are relatively attractive at this current point in time. All right, so before I end off, I'd like to summarize what I have gone through in today's outlook. So for the macro portion, our view for this year remains very constructive. I think the big major theme of this year will be a vaccine-led and secure recovery, and we are expecting an above consensus GDP growth of 5.8% this year. And for the equities, we favor EM as well as Asia and Japan equities. And that is largely based on our preference for a pro-risk and pro-cyclical approach. And with that said, our top picks within the markets remains China, Hong Kong, South Korea, Indonesia, and Brazil. And last but certainly not least, for the asset region, for fixed income, we favor high yield over investment grades, and our top picks remains Asia high yield, EM hard currency, and EUM local currency. And finally, for asset allocation-wise, we favor equities over fixed income, and we recommend a modest overweight of equities. Well, so that brings me to the last slide. So once again, I thank everybody for staying through together with me for this presentation. Thank you for your time. And before I end off, I would just like to say, please take care in this COVID environment out here. So see you guys next year, and goodbye.